Hello, everybody. Welcome to this webinar brought to you by Wealthford in sponsorship partnership with Macquarie Warrants Malaysia. So our webinar title today is Technical Trends in Asian Equities. So my name is Shen Chu. I'm the moderator for this session. Now, if you have ever looked at the charts and thought, is this a good time to buy right now? Or is it a good time to sell? Is there any trends that's being formed right now that we can do a momentum trades? Is that the real breakout or is the fake out? So if you are not certain about how the trends look like in Asian equities, especially, so today we are going to address how do we decode the trends in the market at the moment. So we have invited two speakers in this session. Our first speaker will share about his outlook for the Asian equities and also the strategies to trade the Asian equities. And our second speaker from Macquarie will talk about how the use of structural warrants can complement your trading strategies in Asian equities. So, disclaimer, whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you are solely responsible for all your investment risk. Allow me to briefly introduce our first speaker. He's the founder and chief trainer for Shareware Consulting. He's also a dealer representative with TS Securities. He'll apply technical analysis in his trading, mainly focusing on share movement analysis, price volume analysis, indicator, candlestick formation to observe the buying interest and selling pressure and further justify the key supports and resistance level. His forte is in understanding the movement of buyer and seller through the distribution area of banker chips. He's also a regular speaker for a number of financial institutions to train their clients in trading. That include Kenanga Investment Bank, Macquarie, Malacca Securities, and TS Securities. He was also invited to speak for investing notes and SGX, as well as other tertiary educational institutions such as UTAR, TAR UMT, and also UUM. So having 13 years of market experience, he has trained more than 2,000 students with trading strategy from 2019 to 2021, mountains in England and Wales. He also passed level 1 of CFA. All right. So he's none other than Mr. Chin Yong Chi. Okay, YC. Good morning. How are you today?
Hey, morning. Hey, thank you, Shane. Thank you very much for the introduction.
All right, fantastic. So I will just stop sharing my screen and we'll learn from you about the Asian outlook,
Okay, thank you.
Asian market outlook.
Thank you. Let me share my screen now. Okay, is everything all good? Okay, should be all right, yeah. Okay, so very good morning. Thank you for your time attending this webinar. So first of all, disclaimer. So everything, including the case study that we will be sharing throughout the webinar, is not buy sell call. Okay, it's purely just for the educational purpose and sharing purpose. So this is our topic today. So I'll be covering the concept of trends and also trend trading strategy and breakout strategy and price volume analysis. So after that, after we go through all the theories, then we will combine all the theories together. Then we will go through the real case study. All the case study basically basically are the one that we really traded. So including the local one, the local underlines. So we will apply the strategy that we will be going through later to apply on the case study. So first of all, the concept of trends. So in we call trading, we have to understand what is the trend. Trend is basically the direction that the prices are moving in. So we have to know whether it's moving out, whether it's moving down, or whether it's sideways trend. So basically, there are only three types of trends. So we can see this chart, this graph. An uptrend is basically made out of the ascending peaks and drop, higher high and higher low. Basically, it means that the price continue to go up after a healthy retracement. It goes up and it retraces, and it will continue to go up again. So forming a higher high and a higher low means that the high is going higher, okay, and the low also going higher. So once we connected all the trend together, all the low together, we can see is an uptrend. So the other one is the downtrend. Basically, it means that lower highs and lower low. Means that as time goes by, the stock price continue to drop. So it's a descending peaks and trough. So we can see the other one is the sideways trend. A sideways trend, basically we call it consolidation. Consolidation in our trading world means that no direction. There is no clear direction, whether it's going up or whether it's going down. So we have to wait for it to choose direction. In our trading world, technically, we call it waiting for it to choose direction for ourselves. Okay, we no need to really predict whether it will go up or it will go down. We just wait for it to form a clear direction for us. Either it breaks down the support, so it form a breakdown, or it breaks out the resistance, it form a breaks out. So we have to wait until the stock itself choose a direction for us as a trader. Before it, we don't need to do anything. We just purely wait, because during this zone, this phase, there is no clear direction. If we jump in during this zone, basically we will waste quite a lot of our time. We were just playing around the zone. You can see there's a box zone. It means that the high is always horizontal. The low also horizontal. So basically stop price always play around this zone. It goes up until the red zone, it will get hit down. So it goes down until the green zone, it will get supported. There's no clear trend. So if we jump in, although we can like buy at the support and sell the resistance, but that is not that strong. It's quite weak. So we have to wait, wait for it to rebound to the resistance, then we sell to take profit. Then we have to wait for it to go back to the support, then we re-enter. But it takes a lot of time. No clear trend. So basically, in summary, we can see this chart. Okay, by seeing this, we can know uptrend is higher high, higher low, and the sideways trend. Okay, then when the sideways trend gets breakdown, so it will turn to downtrend. Downtrend, it means lower high and lower low. Okay, here's a question, which stage should we enter a stock? Okay, what we will suggest is that although downtrend, you can play the rebound. You can see when it get hit down, it will get rebounded. Some of the people, they like to catch the bottom. Then they take profit during the rebound. But usually what we will suggest is that preferably we go and enter the stock in the uptrend section. It's because even though you buy a little bit higher, when it breaks out, we buy a little bit higher, we still get a chance to sell even higher. We will not be trapped in the counter. But for the downtrend counter, okay, if we want to play bottom catching, okay, we thought that that's the low point already. A lot of people usually experience this. Once we get in, we might get stuck, because the low that we think is the low is actually not the low. We enter during that session, it will get breakdown again. That's why usually we will suggest we just enter a stock in the uptrend section, because it will tend to trend higher. You buy a little bit higher, although your risk is a little bit higher, but the stock already started to have momentum. Okay, it start to trend up already. Okay, so as time goes by, you still potentially high chance. We cannot say 100%. There's no 100% in stock market. Okay, There's no 100% in financial world. There's no 100% in trading. But we can say high chance. High chance it will go higher. Then be able to sell it in a higher price and exit. Okay, so uptrend. Second is the sideways trend. So try to avoid the downtrend counter. Because downtrend counter, it requires us to have more experience to trade. And we have to have a very good risk management. Like once we bottom cash and fill, we have to exit already. We have to cut loss already. But a lot of people, when they enter during the downtrend session, they want to bottom cash. But in the end, they feel they also thinking like, oh, never mind, probably it's just the matter of time. So they continue to wait. But as we mentioned just now, for the downtrend counter, as time goes by, it will continue to trend lower. Okay? Uptrend counter, as time goes by, it will continue to trend higher. So if you buy the downtrend counter and you feel you did not choose to cut loss, then you might have a lot of trouble. Okay? So the other one is the trend trading. Okay. During the session just now, we learned about trend. Okay, now we go slightly deeper. We learn about trend trading strategies. So basically, this one we will be covering trend lines and also the moving average strategy. Okay, trend lines. Trend lines basically is that we have to connect a few points. Okay, in our trading world, we call it most touch point. Means that the point that you can connect as much as possible as the low point or as the high point to form support or resistance. Like for example, in this case, okay, we can see that we can connect a few of the low point. Okay, a few of the low point. So once we connected all the low points, we can see this one is a uptrend line. This one is an uptrend line. The line is moving upwards. Okay, so this uptrend line acting as a support. It means that more demand than supply. How we know it's more demand than supply? Because you can see whenever the price retraces to a certain zone, so people will come in and buy, continue to buy. So it will make the price continue to trend higher. And every time when it retraces, it wouldn't retrace back to the previous retracement point. So it means that more demand. Like today, people accept that, okay, 1 ringgit is the lowest point. Then the second retracement, market people thinks that, okay, 1 ringgit 10 cents is the lowest point. So it means that people is willing to pay higher, to enter into this stock. That's why there's more demand than supply. Okay, by connecting the low point. This one is the uptrend line. The other one is the downtrend line. Okay, downtrend basically we connect 2 or more of the high points. If you're able to connect more and more, means that this resistance, this high point is a more valid point. It's a more valid one. Okay, so that's why we always tend to look for the most touch point, most touches point, which able to connect more and more points. So this one will be a strong resistance, we call it. Okay, so resistance, it means that more supply than demand. Like the example that we have given just now. For example, now the high point is 1 ringgit. Means that when the stock price hit 1 ringgit, trader will sell at that zone. Okay, then it will get hit down. Probably it retraces to 80 cents and it start rebound. But when it rebounds, it wouldn't get back to 1 ringgit again. Probably it goes to 90 cents. Then seller in the market, they start selling already. Okay, means that the higher point is getting lower. Previously 1 ringgit, now it rebound, it can only rebound to 90 cents. Then it get hit down again to 70 cents. Then when it rebounds, it won't be able to rebound to 90 cents again. Probably it rebounds to 80 cents, then it will get hit down again. Means that people think that they want to sell in a cheaper price already. It means that the resistance is getting stronger, supply is getting more than the demand. Okay, so this one is by connecting the high points. So once we learn about the trend lines, we learn the other one is the moving average. Okay, moving average basically is a stock indicator commonly used in technical analysis, TA. Okay, so it helps trader to filter out the market noise and identify the underlying trend direction. So basically, we can know that moving average, it acts as support or resistance. It's quite same as the trend line, but trend line is a very straightforward line. Okay, but the moving average is a average prices. Okay, it average out the price, then we can see whether the moving average is trending up or is trending down. Like in this case, if the price continue to trade above a MA, moving average, it will suggest an uptrend is in place. Okay, you can see in this case, the green color one is the trend line that we learned just now. But you can see the red color and the green color, the lines, basically is the moving average. Okay, it's not as smooth as the trend line, but it will give us a general direction. We can see it's very obvious that the price is trending out, during the pullback, it did not break the uptrend line. Okay, then the moving average continue to slow up. Okay, it provides us a general direction. The same goes to during a downtrend section. The green arrow is the downtrend line that we learned just now. So you can see the line, the two lines. The two lines basically, one is the shorter time frame moving average, and another one could be the longer time frame moving average. So what is the time frame that we can use? Some of the people, they use 20-day moving average, comparing with the 60-day moving average. Okay, this one is usually the so-called midterm setup. Whenever the short-term one is trend below the long-term one, means that the trend changes already. So that one is the MA cross. Some of the people, they use the moving average of 5 days compared with the 10 days. So if let's say the 5-day ones start to go up above the 10 days one, means that the short term, the price is going up. Okay, so it depends on what is the strategy that trader wants to use. Some of the people, they prefer very long term one, so they will use 120 days compared to 240 days. So there is a reason behind all these numbers. Like for example, let us think, how many days of the trading day in a week? We know, okay, there's Monday to Friday, 5 days. Okay, so people use MA5, 5 days moving average. It's a very short-term setup because 5 days is 1 week. Okay, so they will compare with what other time frame? They might compare with the 10 days time frame. 10 days is the 2 weeks time frame. Okay, so when the 5-day time frame, the moving average start to go up, it means that the price start to pick up again, start to move uptrend again in a very short-term basis. Means that for the nearest 5 days, the stock price spike. That's why the moving average, the average price of it, start to go up compared to the 10 days one. So just now we mentioned about the 20 days. 20 days, let us think, there's 4 weeks in a month. Okay, 1 week, 5 trading days. So 1 month is 20 days. So the 20 days is very important. Okay, 20 days. Then and a quarter is 60 days. That's why they can compare 20 days moving average with the 60-day moving average, which is the midterm one. Okay, then annually will be probably 240 days compared with the semi-annually 120 days. That's how the setup coming from. Okay, so it depends on whether you want to play the short-term one, mid-term one, or the long-term one. But overall is that the moving average, it provides us a direction, a general direction that the price is moving in. Okay, so this one is a summary. Okay, you can see that when the trend going out, moving average should increase over time. Okay, it means that the stock price trades higher, and also the moving average will act as a support to the uptrend counter. Okay, same as the trend line that we learned just now. The same goes to when the trend is a downtrend, the moving average should decrease over time. Means that it trend lower and lower. Okay. Now this is one of the example. You can see that whenever it retrace, it should retrace with low volume and it should not break down the support line, the moving average support line. Okay. So why when during retracement, it should retrace with low volume? Because low volume means that lesser selling pressure. This one is just a healthy retracement. It's not like those big big player inside, they're really selling heavily. So during a healthy retracement, we prefer lesser volume. Okay. So once we have learned the trend, or also trend trading strategy, so now we go to the breakout strategy. Usually we, as a momentum trading trader, usually we focus more on the breakout because like we just now mentioned, during the sideways, we don't need to buy because it's basically waste of our time. We have to wait for the counter to choose the direction itself. Then only we start to, monitor this counter or we start to find the entry of this counter. So basically breakout is that when the price breaks the resistance zone, it means that the momentum start to pick up. And also, it means that the stop price has already chosen a direction for us. Okay, because there's a lot of news happening in the market. And we as a retailer, it's really difficult for us to catch the first-hand news. That's why we don't need to find the first-hand news one. The price action will show itself. When there's a first-hand news or there's something brewing, the price might react accordingly. So if a price already break out from the sideways zone, it means that, oh, this counter, basically we know it has momentum already. It has already broken out. It's time for us to monitor it. It's time for us to find an entry to it. Yeah. Okay, so this one is the supply and demand. Basically, we can see the right-hand side one. Okay, right-hand side one, because in Malaysia, we cannot really like short a counter. Even though you short IDSS, you have to buy back during the day. So we focus on the right-hand side one, which is the breakout. It's not a breakdown, it's a breakout strategy. Okay, you can see once a first markup zone means that the first rally, after the first rally, usually the stock price will go into a sideways zone. Okay, during the sideways zone we call it consolidation zone. It's the retracement zone. So retracement, like we mentioned just now, it should, healthily saying, it should retrace with low volume. You can see down there, low volume base. Why it should retrace with low volume? Like we just mentioned, it means that the selling pressure is not that huge. It's a healthy retracement. It's the healthy selling pressure, just like normal taking profit. It's not like those big players, they just want to dump the share price. Yeah, they're just like normal selling, or those contra player. Okay, they have the time limit. They're just normal taking profit, or they're just normal cut loss. That's why the volume should be low. Means that the selling pressure is not that huge. It's within a controllable range. Then once it continue to rally again, it breaks out of the sideways zone. Okay, it breaks out of the sideways zone, the net line zone. Okay, then it will continue to have the second markup. Okay, second rally. It means that more buying interest when it breaks out, more momentum. So usually for breakout trade or for those momentum trading, we find all these counter. And honestly speaking, all these counter, you'll basically see in the top gainer, top turnover, top volume. Basically, you will see repeat and repeat again. Okay, later we will show some case study. So there are a lot of types of breakout. So we will just go through a few of them. Like this one is the triangle breakout. So triangle breakout, we connect the high to high, and also we connect the low to low. So we will notice that, okay, basically two direction is getting more narrow. Okay, means that the room for the price to react is getting lesser. So until a certain period, it should choose the direction for us. Either it start to break out or it will break down. Usually, if an uptrend to continue, it will, after it consolidate, it will continue to break out again. Okay. The other one is the downtrend line breakout. This one basically we use it quite commonly. Okay, we can see this one. Even though like the triangle breakout, even though we didn't connect the low to low, we only connecting the high to high. Whenever the stop price, the red arrow, when it breaks out of the high to high resistance zone, we can see that it's quite the same as the downtrend line breakout. Means that we're connecting the resistance. Whenever the price hit the resistance, it get hit down. Okay, until one day, the price break out of the resistance zone, the downtrend line zone, means that the price, the stock has already chosen the direction for us. Okay, so all this is very similar. All the concept once we learn is very similar. Breakout strategy means that whenever it breaks out of the resistance zone, this is the breakout. Just different formation, different names. So if we cannot remember the names, it doesn't matter, as long as we're able to know the concept behind it. Like for example, this one, you can see what is the high to high point. The high to high point is a horizontal line. Okay, whenever the stock price breaks above the horizontal line, it means that there's a breakout. Just that in this case, it's called a net line breakout, just different name, but concept is the same. Means that when the momentum comes, it breaks out, then it healthy retracement and it continue. Yeah. So this is one of the example. Basically, this one is a cup and handle breakout. The handle should be smaller in a more classic formation. Okay, so even though for the big counter, like this one is the RGB, is a big cap counter, you can see the formation still applies. Okay, the same concept still apply here. Okay, so just the matter of names. Like this one is a, you can call it cup and handle, you can call it net line breakout, you can call it just a simple breakout or boss breakout. Yeah, many names, but the most importantly is that it breaks out of the resistance, which this resistance zone previously always get hit down until one day momentum comes, then it start to move out above that zone, then that zone become a new zone of support. Okay, so this one basically is a type of breakouts, a lot of breakouts, a lot. Okay, but whenever we share to those attendants, participants, or our students, clients, we will always tell them the same. No need to remember the name. No need to remember the formation's name. As long as you're able to identify what is the resistance zone, what is the support zone, what is the breakout zone, the price action, okay already. No need to remember the name, because English, this type of nation in English, it has an English name. In Mandarin, it has a Mandarin name. Then for the Mandarin one, in Taiwan, has another name. In China, it will have another name. But it's basically the same formation, just different names. That's why, even though we learn a lot, but we will encourage people to, remembering the name is not the main point, but identifying the formation is more important. Okay? If everyone okay until this stage, kindly comment a one for me. Comment a one for me. Then we will go to the price volume analysis. This one is more towards the actual trading. Okay. Okay, thank you. I see quite a lot of the comments. So price volume analysis. Basically, after we learn all the concept previously, then now we apply. Okay, we apply into the price volume analysis. So price volume analysis is very important, especially in technical analysis, because we need to understand what is the relationship between the price and the volume. Okay, because the price and the volume is the info that we can get through the chart. All other information is we call secondary. For example, like the moving average. The moving average, we use the price as the primary data. Then it get a average price. Then plot the moving average. Okay, so all these other indicators that we learn, like for example, RSI, KDJ, MACD, all those commonly used indicators is all the secondary data. Okay, I believe a lot of people here might have already heard of those other indicators. Okay, we might use it as well, but we prefer the price volume analysis because it's more straightforward. This one is the very primary data in the chart. In the chart, during a bear chart, in a bear chart, the only thing you can see is the price and also the volume. So this one is a very primary data. Okay, so it helps us to identify an actual trend. So price action. So price action basically is that we have to think, how is the price reacting? How is the price moving now? That's why from this chart, this one is a very simple example. Without any indicator, we see only the chart movement. We see only the volume. Then we predict or we understand what is happening to this counter. It might not be 100%. There's no 100% like we mentioned, but it provides us a better chance to trade in the market. Okay, so understanding the volume. Basically, volume, we prefer increasing trading volume, okay, during a strong uptrend. During a strong uptrend, especially during the breakout, it should break out with increased volume. If the breakout doesn't come with increased volume, we will personally think that this one is not a very classic breakout. It's not as typical as those breakout with volume. Why? Because like we just now, during the previous session, we have already mentioned that what does it mean a breakout? It means that it breaks off the resistance, a break of the resistance. The resistance where previously, every time when it get hit, the stop price cannot move out. Okay, means that a lot of trap chips over there. So if we want to have a solid breakout, means that all the trap chips need to be absorbed. So to absorb all those kind of previous trap chips, we need a very strong buying power to eat over it, to buy over it, to absorb it. Yeah, that's why all these so-called the big volume is the momentum, is the actual buyer. That's why we prefer, especially the breakout near the critical resistance zone, we will prefer it to come with increased volume. Okay, and also the price. Basically, the price. Some of the people they will see, you know, different prices, opening price, higher price, lower price. But for us, we see for the previous data one, we see only the closing price and opening price. Then the high and low is not as important as opening and closing. Okay, but during the drawing of a chart, as long as you can touch more of the points, okay, even though there's a high point, low point, opening price or the closing price, as long as you draw the trend line, you draw a downtrend line, uptrend line, you can hit most of the point, then the one is a solid, more solid line. Okay, we can see the example given here. During a strong uptrend, price continue to go up. The volume should continue to go up as well. Later we will go to the case study, you can see it. But if the trend is not that strong, you can see as the price trend out, the volume is getting lesser. So it's not that strong. Okay. So this one is a very typical price action. This one, especially in Bursa, in local trading, we have to remember this formation. It's very important, and it's very high success rate. Okay, compared to the if let's say you are more familiar to the Hong Kong stock or you are more familiar to the US stock, they want probably you have another type of the classic price action. But in Bursa, this one I can show that is quite commonly seen, but whether we're able to spot it or not. Okay. In short, it means that when the price continue to go up, the price, the volume should increase. And when it retraces, like we mentioned many times already, when it retraces and the retracement is a healthy one, we call it healthy retracement. Okay, it should come with low volume because it means that the selling is not huge. The selling probably is just a normal retailer exiting. Either they cut loss because probably the contra player, they bought at a high price. Then during the 2 days retracement, their time limit has already reached T3 already, on the force sell already. That's why those retailer, they just cut loss. So even though the candle is in red, the candle is going down, but the volume is not that huge because there's only like retailer cutting loss. It's not like the big boys. They really want to dump the share in a very high volume basis. Okay, so what we need to find is the breakout with huge volume and the retracement with the low volume. This kind of setup is the typical setup, okay, that we can see in the Malaysia momentum stock. Basically, every momentum stock, like I can say like 90% over, when it start to break out, it should break out with volume. And the healthy retracement, it should retrace in low volume. Okay, you can see this one is a previous case study, okay, but it's still very good example. You can see when it start to break out this zone. Okay, this zone, what is the breakout? What is the breakout name? We can call it neckline breakout. We can call it the box breakout. A lot of names, but doesn't matter as long as you can spot the breakout. You can spot the breakout. It basically means that it breaks above the resistance. Okay, you can see when it breaks above the resistance, this one is the very call it critical resistance. Okay, because throughout previous period, the resistance always there. Okay, every time it hit, then the stock price start going down. That's why it's a very typical, very critical resistance. So when all these type of the resistance, it wants to form a solid breakout, it should go with the huge volume, like we mentioned just now. Means that the buyer actually eat over the seller, eat over the trap chips. This is a solid buyer. So you can see the volume compared to the previous volume, the volume is obviously higher. Okay, then when it retraces, you can see the volume, you can see the red candle. When it retraces, you can see the retracement candle volume is very little, probably only 1/3 or quarter compared to the breakout volume. This one is the classic one. Okay, breakout with the increased volume and also retracement with the low volume. Okay, I can see some of the question. You all can comment in the chat or the Q&A section in the Q&A box. Then I will one shot settle it after we finish the case study later. Okay, so here comes the case study. So in the case study, I will cover basically all those counter in the we call it in the Bursa and also in the overseas market. All this counter is the counter that it's not the previously examples. Whenever during the section we will use those case study as fresh as possible. So this one is the eco shop. Okay, we can see even though like I mentioned just now, this one is the RHB, right? So this one is the eco shop. Even though it's a very big cap counter, we call it very heavy, compared to those small cap, mid cap, but those technical analysis strategy still can be applied. Okay, so what is this? This one is the neckline breakout. Neckline breakout, and if you're connecting the low point, if you connect the low point, okay, everyone look at this chart. If you connect the low point, you can find an uptrend line, right? If you're connecting the low point, okay, low to low to low, you can form an uptrend line, right? So if you imagine the uptrend line and also the horizontal line, it will form a triangle, right? It will form a triangle. So in a way, it's a triangle breakout. Okay, but if you are more familiar with trading already, basically for a breakout formation, we will only look at the resistance. That's why I only draw the resistance. Okay, I only focus on the neckline breakout. Just the name. Okay, just the name. Just what I want to bring out is that all these things, all this formation, a lot of formation, a lot of names. You don't need to remember. You just need to know the concept of it, and you only need to know how to spot it. That's all. So in this case, we can see it start to break out of the resistance. Okay, and you can see the retracement comparing to the breakout volume. The retracement volume is lesser. Okay, so in this case, how are we going to analyze it? We can analyze in a way that as long as the stock price continue to stand above the breakout zone, means that it continue to support above the breakout zone, then it potentially, or it might rebound back, it might trend higher. Okay, it might trend higher. Okay, so this is how we analyze it. Okay, so if let's say a trader, it missed the breakout zone already, it missed the first candle which break out of the resistance. If the person miss it, then what he can do? He can wait for the retracement. No? Like in this case, it has already retraced. Okay, so instead of you go and chase high, you can wait for the resistance. You can wait for the retracement, and you can consider whether you want to enter it. Okay. The other one is the Gamuda. Okay, so what is this type of breakout? It's a downtrend line breakout, right? It's a downtrend line breakout. Okay, it's very obvious because, like we mentioned just now, a downtrend line is the line that whenever the price hit the zone, it always get hit down. So you can see the red arrow. Okay, it's always the resistance. Okay, imagine this. Until one day, the stock price start to go above the downtrend line. It means that the stock price has already picking up the momentum. The stock price has already changed of trend. We call it change of trend. Okay, like just now during the first session, we learned about the trend, uptrend, sideways, and downtrend, right? So this one is the downtrend. When a downtrend cannot be supported already, when the downtrend line is being broken up already, it means that a change of trend happened. Okay, the stock price continue to break out and continue to trend higher. Okay, so how to identify the downtrend line? By connecting the high to high. You can see by connecting the high to high, we form a downtrend line. And this downtrend line is a resistance. When the resistance is being broken up, it's a breakout trade. As simple as that. Okay. So this one is the other big cap. Okay. This one is the YTL power. You can see my first red arrow, small arrow. That one, what is that again? That one basically is a neckline breakout. Okay, because horizontal line resistance. So when the stock price break above the resistance, it's the neckline breakout. Okay, if we zoom in, we can see a very short time frame of the cup and handle breakout. Okay, but I didn't draw it because every time there's a lot of names, a lot of formation happening in the chart. But more importantly is that we're able to identify the breakout zone. Okay, if you zoom in, you can see there's a very small cup and handle breakout. Okay, the first cup is when it retraces to 2 ringgit and 10 cents. Okay, then it go back to the neckline zone and it retraces a bit. Is the handle. Okay, there's a very small cup and handle breakout. So a lot of breakouts. Then the other, I draw a 3 horizontal line. You can see the middle one. The middle one is another neckline. If this neckline is being broken out, it means that, oh, this one is another breakout. So if it sustains above the middle one, then it tend to trend higher to the most top one, to the third neckline zone. Okay, that's how we identify it. Okay, whenever a neckline is being broken up, it will form a new support. Okay, so this is the index. You can see. Basically, this one is supported on the moving average. Okay, moving average, that's how as we learn, it provides us a general direction. So we can see that as long as the price continue to move above the moving average, okay, basically it's an uptrend. And what is this type of breakout? Is also a downtrend line breakout, or you can call it a breakout, simple breakout, because you're connecting the high to high and the stop price already break above the high. Okay, and it continue to support above the MA. Uptrend moving average, we call it. This one is the HSF. Okay, you can see another type of breakout. Okay, this type of breakout, if you only draw the high to high, what is this called? This one is neckline breakout. But it's very obvious that this one is a boss zone because the support zone is also a horizontal support zone. So you can know that this zone is a sideways zone. Sideways, as we learned just now, is a consolidation zone. When the rally happened, first rally, after that it consolidates. It go into sideways. So during the sideways, it's nothing much we can play. Up, down, up, down, up, down. There's only within the zone. Until one day, imagine this, until one day, the stop, okay, he has chosen a direction for us. It start to break up or it start to break down. In this case, it start to break out. So this one is a new trend. Box breakout, box consolidation breakout. So all these different names, but as long as we're able to spot the resistance breakout, then it will be fine. Okay, this one is pop mark. Okay, this one is uptrend above moving average, very strong uptrend above moving average. Okay, if this one we just simply use the moving average of 20 days. So you can see most of the time is trending above the moving average 20 days. So if a person wants to go to a more midterm one, so the person can use 60 days. But usually midterm one we use 20 days already enough. You can see more or less the time, most of the time it start to trend above the moving average. For this one is a Xiaomi. Okay, you can see this one is what this one is an uptrend line support. You're connecting the low to low. Okay, and the more of the candle point, be it the low point, opening point, or the closing point, highest point, as long as you can connect as much as the candle that you can, this one is a more solid trend line. In this case, you can see this trend line already connecting most of the candle. So this one is a uptrend line. So better the stop price continue to move above the uptrend line. Otherwise, it will be weaker. Okay, Tencent. What is this? This one is a downtrend line breakout. You can see every time it hits the resistance zone, it hits the downtrend line zone, it will get hit down until one day it breaks out. We don't know which day is it until the stop price choose the direction for us. Then we can know, oh, okay, this one is a breakout. Okay, then after the breakout happens, as long as it's maintained above the breakout zone, means that the support is intact. Then the price might continue to go up. Okay, this one is the Nikkei, the index, the Japan index. You can see, even for the index, you can use those simple price action to see. By connecting the high to high, there's a very obvious downtrend line. Okay, so once it break out above the downtrend line, it shoots for a few days and it goes to the consolidation zone, like the HS cap just now. Okay, box consolidation. So until one day it breaks out of the box, this one is second rally. Okay, so basically this one we call it the breakout continuation. Means that first breakout, then it retrace or it rests for a while, it consolidate for a while, then second breakout. The trend will continue. This one is a local one, the local counter. We can see, we see the formation and also we see the volume. This one is also breakout continuation, means that it breaks out and it retraces. Okay, when it retraces, you can see the, okay, we see the volume first. When it breaks out, the volume in green color volume is obviously higher than the previous one, right? And the retracement happen. When the retracement happens, you can see the red color one, the red color volume is obviously lesser than the green color breakout volume. Okay, so this one is the typical Bursa setup, Bursa hot counter setup, like we mentioned just now, those typical, very classic price action. if you're able to spot this kind of breakout, even though the stock price already moved up a lot, okay, you no need to chase high. You wait for retracement, then you enter. Usually it retraces for 2 to 3 days. Usually the classic one 2 days or 3 days. Classic one better 2 days. Then the third day, it will start to go up already. Usually in Bursa, okay, you have to remember this. Then you can see when the second breakout happen, the volume is very huge. So this one also breakout continuation. Breakout, rest for a while, continue to break out, then rest for a while. Then the red color line, that one is what? That one is the net line breakout, right? Because all the while previously it touches two times, then it get hit down, okay? Until this time, it breaks above. So this one is a new support, okay? Then other than LC Titan, the other one is Tan Chong, okay? But LC Titan, it has the we call it structural warrant to leverage on, but the Tan Chong doesn't have any structural warrant to leverage on. So for the structural warrant part, later another speaker Afiq will talk about it. So in this case study, I only put in LC Titan, okay, because it has the good setup. It has also the structural warrant to leverage on. Okay, this one is another one. Okay, the next G. This one is downtrend line breakout. Okay, the downtrend line, the red arrow zone, is the zone that we spotted, because you can see, okay, the one is before all the uptrend happens. You can see by the time of the red arrow zone, the volume is already quite obvious higher than previously volume already. So this is the zone that we spotted. This is the zone that we spotted, but I didn't hold until this zone. We bought it and we already take profit. So you can see after it continued to trend higher above the moving average, the volume getting bigger and bigger. Okay, strong uptrend, volume has to support. And also the price need to maintain. Okay, and for this counter, unless those traders that has already have position inside. Otherwise, for the new trade, usually people won't trade already because it doesn't have a very obvious retracement that compared to this one, like Tan Chong, sorry, the LC Titan or the Tan Chong, you can see later yourself. Those kind of big rally and a very obvious retracement. For this type, every day it moves few bigs, but it doesn't have very obvious retracement. So unless you buy it early and you continue to hold as long as it move above moving average. Otherwise, for now, we don't have any good entry yet. Okay. Okay, so I hope all of you learn something. If you all learn something, comment a 2 for me. Then let me see. I got 5 minutes for the Q&A session. Then after that, I'll pass the floor back to Shane. Then if any question that I'm not able to answer, you all can continue to ask. Then I will reply in text message. Okay. Let me see. Okay, Q&A. How you
Yes.
determine?
Question?
Sorry. I think I saw some of it.
Yep. Let me post the first question to you. How do you determine a trend is reversed and what are the criteria? So this question is by Yok Long.
Okay, a very good question. So just now as we mentioned, for example, during a trend, right, during a trend, we can see there's only see. Okay, you can see this slide. Okay, so during a trend, there's only 3 types of trends. So whenever a breakout happens, so for us, it's a change of trend already, as long as it's sustained. For example, you can see the sideways trend here. If one day the stock price start to break down of the support zone, means that the low point of the sideways zone, it means that a change of trend happened. Then it's the start of the downtrend. Even though it break down and it retraced, it break down and it retested the resistance. It should not go back up. It should not go back up to the previous breakdown point. Means that it basically rebound a while and it will continue to drop. Okay, so whenever a breakout or breakdown happen, we see the volume also. We see the formation first, then we see also the volume. Just now I mentioned, breakout with volume, then the one is the solid one. We can have a more chance, more higher probability to confirm there's a change of trend. Okay. Then the second question, let me see.
Okay, thanks, YC. The second question here is, how do we identify from a daily volume chart that there are more buyers or more sellers that day?
Daily volume chart. Okay. To be honest, if you're asking about the day itself, it's really difficult for you to see only by the daily chart. Because the daily chart, if you only see the day chart, you did not go into the other time frame, such as 1 hour, 15 minutes, or 5 minutes chart. It's really difficult for you to see at which price there's more seller or more buyer. So if you're asking this question, to be honest to you, you have to go to the platform. You have to go to the um, trading platform, and you can see the VWAP, um, volume weighted average price. The platform, every trading platform, basically it will show that. So if you are asking of the day itself, so usually we will see the VWAP. Means that that is the price where most of the trade averagely done there. So that's the price that we will refer. Okay, if you are seeing only the day chart, you are asking whether you want to know whether there's more buyer or seller, we will see only the final result, which is the color of the candle. Okay, the color of the candle, if it's green color, we will think that, okay, this one is basically the day is a day which is the stock price going up. Okay, if the red color, if the candle color is red, so we will think that this one is more seller day. The day which more seller is during the stock. Okay, so if you want to have more in-depth analysis, we will suggest you to go into the platform to see. And also you want to see we call it market depth, those business done, like what price being thrown, what price being eaten out. The one is more complex. So to simplify, to summary the answer, we will suggest that if you don't want to go too in depth, basically based on the daily chart, you can see the conclusion by the color of the volume. Okay, very little chance, very little case is that sometimes during the closing, some people tend to eat out a bit, close it green. It might be the case, but it's very little chance. So generally speaking, you see the final result. You see the final result, which means if the candle is green, you can assume more buyer. If the candle is red, or the day, more seller. The one is a seller day. So yeah, I hope I answered your question.
Thanks, YC. The next question from Modit Gangao is that in the eco shop example, where would you place the buy order once the neckline breakout has been spotted? Would it be at 1 ringgit 29 cent? Can you pull up the chart?
Uh, Let me share. Hope I have the time. You're able to see, able to see this.
Yes, can see your trading view.
Okay, so eco shop. So basically is okay, to be honest, this zone is the previously zone that we start monitoring already. This zone, because this one is a fake breakout. Because it didn't, you see, the volume is really good. The volume is very high. Okay, but it did not close green. It did not close green. It means that it tried to break out, but in the end it failed. Okay, so that day was the day actually we already start to see it, honestly speaking. But it failed. Okay, so okay, just now someone asked about the seller and the buyer thing. Now you see like this that we mentioned. In a very general speaking, you see the final result by the color of volume. This day, red color means that more seller than buyer, as simple as that. Okay, so we continue to the question just now. So in this case, basically, once the breakout happen, okay, this zone, once it break above, so better we can enter here. Okay, even though for the first candle already go out here, first candle, you can also make an entry one here. Okay, because it didn't go out very far yet. Okay, if one day like the Tanchong case or the LC Tanchong case, okay, like this type of case, when you spot the price it has already gone out this far, then you don't need to make any entry. You just wait for normal retracement. You see, it will retrace for 3 days, 2 days, 3 days, like we mentioned just now. And when it retrace, it should retrace with low volume. Okay, so can see the chart. Somebody say no chart.
Yes, 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 there's a chart.
Okay, cool. Okay, so let me see. Okay, so just now, 1 ringgit and 29 cents. Basically, the for the eco shop one, it's very difficult to buy at that zone unless during the previous breakout here, you have already made an entry here. Okay, you have already made an entry, but you think that okay, since it's only retraced for 1 or 2 bits, then you continue to hold. Okay, you continue to hold. You can see all this, the cup and handle also small breakout. Okay, so all this is different types of name of the breakouts. So for the 1 ringgit and 28 cents, it's very difficult for you to buy at that zone unless you buy at home. Honestly speaking, unless you buy at home during this zone, then you will get a lower entry, but you will need to spend some time of waiting. Okay, so if you buy during the breakout zone around 31 cents, you buy a few bits higher, but you might save some time. Okay,
All right.
so
Thanks, YC. So I noticed there's still some question for YC, but we have to move on to the next speaker already. But YC will still be here to address your Q&A if you have more question for him, lah. Yeah. All right. So I will just share my screen, YC. You may share your screen.
yeah, sure. Thank you.
All right.
Okay, pass by the floor to Shane. Thank you.
All right. So the second segment will begin with the equity derivatives sales specialist from Macquarie to share with us how do we use structured warrants to complement momentum trading strategies. So allow me to briefly introduce his background. Mr. Afiq Suhaimi has been a part of the Macquarie Warrants Malaysia since January 2022 and is an emerging voice in the equity derivative sales team. He is involved in the issuance, sales, and marketing of structured warrants listed on Bursa Malaysia and is actively engaged in sharing his knowledge as part of the desk's ongoing warrant education efforts to help existing and potential Malaysian investors gain awareness and a solid understanding of these products. So let's welcome Mr. Afiq Suhaimi. Afiq, how are you today?
Hi, Shane. Doing good right now.
All right, fantastic. So we can't wait to learn from you about structured warrants, what they are, and how we can use it to amplify our gains. All right.
All right. So I'm just sharing my screen. You can see my screen, right?
Yes, perfect.
Okay. So everyone, thank you so much for still joining this session, and thank you so much for YC for explaining on the technical analysis part. So my role today is to explain to you how you can complement your trading using another set of products, which is structured warrants. Structured warrants is basically a leverage product that is listed in Bursa Malaysia. So more details about this product, which is structured warrant, will be explained to me later. I will also explain to you how to choose this warrant, how to also use the kind of strategy that YC explained just now to trade warrants, and some details on warrants that you might probably missed out if you haven't joined my session before. So without further ado, I'll just start my session. Right. So just as a disclaimer before I start, this presentation material has not been reviewed by the SC, and all the investment products, including warrants, are subject to significant investment risk, including the possible loss of principal amount invested. So I'll explain to you about this more on the next slide. So just to start, I want to explain to you about details there is about structured warrants. So basically, if you want to understand more on warrants, right? It's actually a product that has already been listed in Bursa Malaysia. It's a derivative product that follows the performance of any underlying, such as single stocks, index. So all of these can be local and foreign, and ETF, and also commodities. So what attracts people to trade structured warrant? One of it is because there's no margin call when it comes to trading warrants, right? So if you trade something like options, right, you have the possible risk of losing more than what you invested in, right? There's a negative loss also. So when it comes to structured warrant, there is no such thing. So if you were to lose your investment, it is only up to the capital that you invested in, right? So why people trade warrants is because they want to have exposure with just a fraction of the underlying price, right? So why you trade structured warrant? The first one is the less capital, right? Warrants are mostly priced below RM1 in the market right now. So you can get Gamuda warrants, for example, below 20 cent, below 10 cent. You can get warrants over Alibaba, Pokmart, or Xiaomi, right? Hong Kong stock warrants below 50 cent, below 30 cent, below 20 cent, right? So there are plenty of warrants over each underlying. So that's an example lah. And then the biggest part is because of the gearing effect. So the gearing enables warrants to move in a bigger percentage. I'll explain more on gearing, but basically it's a leverage. Every warrant comes with its own gearing, and the higher the gearing, the bigger the chances for you to make a profit. But also it comes with a risk, right? So warrants also provide you exposure to foreign exchange. Today, our focus is on the Asian equity market, right? So that includes the Bursa Malaysia, the stocks under Bursa Malaysia, includes the Hong Kong market, Hong Kong stocks, Hang Seng Index, Hang Seng Tech Index, and also the Nikkei. So that's our focus today lah. And with warrants, you can actually leverage over the bull and the bear market using call and put warrant. So I give you an example, first example of how a call warrant is supposed to look like. So basically, POMAT is actually a very underlying that is doing very good lah. The performance is very good. So just an example, a call warrant over POMAT C1, right? So the first one is the underlying name. So this can be any underlying. It can also be Gamuda. It can also be EcoShop C1, for example, right? So this is just to explain to you how you can spot a call warrant. So POMAT C1. So POMAT, the first part is the underlying name, and then the C is the warrant type. So it can be C or CW call or call structured warrants. And then the one is just series A to Z and 1 to 99. Why there's a series? Because there's a possibility that issuers such as Macquarie or any other issuers in the market, they issue warrants, multiple warrants over POMAT. So there can be 10 POMAT. It would mean that there will be POMAT C10, for example, right? Sometimes they are out of number, so they only have A to Z. They only have A to Z letters, so it can be POMAT CZ, for example. So this is how the naming convention works, right? So for put warrant, same thing. The first is the company name. The second part is the warrant type. H or PW is put warrant, right? That translates to put warrant. So basically, put warrant is a warrant that you buy when there's an move in the opposite direction. So, or if you have a bearish view on certain under stocks or index, right? The naming convention is still the same. It's still the same. So just what changes between call and put warrant is the C and the H. It can be H or PW or C or C, right? So that's how you spot warrants. So you probably heard of other leverage products such as options, right? Probably you also have been trading options, right? The options market. So just a quick example or a quick differentiation between these two products is structured warrant is issued by third party such as Macquarie, can be issued by financial entities such as bank as well. Whereas options are listed by the option exchange itself. And the most differentiated part is that structured warrant, it has a presence of market maker and is traded on the Bursa Malaysia. just like your stocks, right? Whereas there's no market maker for options, and you can only trade options in the options market. So in terms of settlement, it's all cash settlement for structured warrants in the Bursa Malaysia, right? And then the denominator is Malaysian ringgit, right? So if I go to another example, company warrants, if I compare structured warrants to company warrants, because probably you would think these are the same thing, but as you know, it's not. Company warrants are issued by the company itself. Okay, so like Encom Nilex, they issued their own company warrant, Encom 9WP. So anything that starts with W is actually company warrants, not structured warrants. Structured warrants is C, CW, H, and PW, like what I've explained earlier. But for structured warrants, right, it is used for investment. And then the tenor is short to medium term trading, so 3 to 12 months, right? For company warrants, is a capital raising tool, and it's mostly for long term investment, right? Okay, so I hope you guys are clear on this part. This is just the basic. I'll go more on the intermediate section of warrants. So basically, you would want to learn about the terms that comes with a warrant lah. So basically, the first term that you need to understand is the expiry date. Every warrant comes with an expiry date, and structured warrants, it is for short term to medium term trading. So expiry date for each warrant explains that the date on when the warrant will expire. So structured warrant has 3 months to 12 months and not suitable for long-term investment. So the longer the time to expire, the slower it is for the warrants to decay. So time decay is something that I will also touch on, because sometimes investors, they ask me, Afiq, I invested in this warrant, I traded this warrant, but I'm holding it until the end. So what happened to my warrant when it reaches expiry date, right? What happened if I hold to expiry date, or what happened to my portfolio now? So I'll explain to you later. Okay. So another term that you need to know is also sensitivity, right? Because you trade warrants, warrants is a leverage product. So each warrant comes with their own sensitive. The lower the number of tick, the more sensitive the warrant is, and vice versa. So if I give you example here, right, between CWE3 and CWGB, CWE3 sensitivity, here, if you go look at the section, the box section here, sensitivity is 37.06 for CWE3, whereas for CWGB is 60.12, right? Probably you guys can comment which of these warrant is the most sensitive, right? So you can comment lah, which of this warrant between these two is the most sensitive. Remember, the lower the number of ticks, the more sensitive it is. CW3 is 37, CWGB is 60. The lower it is, the more sensitive it is. All right, so someone actually mentioned CWE3. That is correct, all right? So the lower the number of ticks, the more sensitive the warrant is. This one contains 37.06. This one is 60.12. Why? Why is the lower number of ticks sensitive? Because for one tick for that warrant to move, it will need the Hang Seng to move by 37 points, right? So if CWGV moves 60 points, the warrant can only move one tick if the index moves 60 points. Compared to CWE3, CWE3 is more sensitive. It only needs 37 points for the index to move, for the warrant to move one tick. Whereas CWGP, it takes more points, right? Thank you for commenting. All right. So the answer here is CWE. Okay. Right. So another terms that you need to understand is effective gearing. Every warrant comes with a gearing. Gearing measures the rate of change between warrant price and also the underlying price. So if warrant moved by approximately X number of percent, for every 1% it moved in underlying. So basically there's a relationship between warrants and the mother share or the index, right? So every warrant has their own effective gearing. For example, warrant A, it has 5 times effective gearing, meaning 1% move of the underlying, the warrant will move by 5%. It will increase by 5%, right? If the warrant have 8 times effective gearing, 1% move in the underlying, in the mother share, the warrant will move 8% more, right? So for put warrant C, 3 times effective gearing, the warrant can also decrease by 3%. So effective gearing doesn't just tell you it will go up, it will also go down, right? It acts as a double-edged sword. So this is one of the risks when you trade structured warrants. Leverage, your portfolio can go up or go down depending on how high the gearing is, right? So just to share with you, what are the things that actually affect the price of warrants? So the first one is very direct, very simple, the share price or the index price. So if the share price increase or index price increase, the warrant will, the call warrant will increase, because call warrant tracks the movement of the underlying goes up, call warrant goes up, right? So if the share price goes down, the call warrant will go down, right? It tracks the same, right? But for put warrant, because put warrant increase when the underlying goes up, right? So it's a different relationship already. It's an inverse relationship. So if you think that there's a bearish movement in a certain stock, right, or the market as a whole, the index, right, you want to leverage on that down movement. So you'll be buying put warrant, be trading put warrant, because the underlying goes down, put warrant will go up, right? So that's the simple relationship when it comes to structured warrants. And then for second one is the exercise and the strike price. Right, for call warrant, the higher the exercise price, the less likely the call warrant to be exercised. Okay, so this one is third to expiry also. So I'll explain to you on my expiry section in a bit. Right, so the third one that will affect your warrant price is expiry date. Okay, so for both call warrant and put warrant, the longer the warrant has to expire, the higher the time value, and hence the price of the warrant. So a warrant with more time to expiry experience a lower rate of time decay. Right. So when there's a lower rate of time decay, which means the absolute price, the bid and the ask price of warrant tends to be at higher, right? So expiry warrant that are newly, for example, yesterday I leased a warrant. So of course, the expiry is going to be in next year, March next year, right? So you have a number of days, higher number of days, right? So the rate for the time decay is lower. So what is time decay? I'll explain to you. Right. So next is volatility. So because warrant also it trades on the volatile movement of its underlying, right? So the higher the volatility level also leads to the higher price of the warrant for both call and put warrants. So what do I mean by volatility? Right. So in warrants, we have something that is called implied volatility, or in simple terms, just call it IV lah. So what causes implied volatility to increase? First is the market-related event, right? Such as if there's a movement in the underlying overnight movement, for example, of the Hang Seng Index. So that will also explains why the volatility of the warrant will increase. And then there's also the increase in the IV of a similar option, you or the OTC market. So basically, this is where we hedge our position as a market maker or issuer. So if the underlying implied volatility increase, the warrant price will also increase, right? So just to explain to you lah, example of price movement of warrant X on day one. On day one, there's no change of implied volatility, but only the change of underlying level, right? So this is on call warrant. So you see the underlying level, it goes up 21,600, 21,700, 21,800. It goes up for every 100 points, right here. So warrant X price also goes up by every 100 points, it goes up by one tick from 10 cent to 10.5 to 11 cent. So the way warrant price it is 0.005. So that's the number of tick, right? 0.005, which is warrant below 1 ringgit. Above 1 ringgit is 1 cent. The tick difference is 1 cent, right? So if you go here, warrant X price, it goes up by one tick, which is half a cent for every 100 point of the underlying level. So this is if you there's no implied volatility changes, there's no IV changes. So warrant X is moving up one tick for every 100 points of the underlying, right? It following the matrix. But in the next morning, right, there's a increase in the implied volatility from 49% to 50%. So Warren X moved one tick from 428 the day after on day one, despite the underlying remaining unchanged, right? 28,800, 21,800. Increase in price is attributed to the increase in implied volatility from 49% to 50%. So why am I showing you this? Because there is a common case where implied volatility of warrants will be increased. So why? If you look on the left, market related event, or there's an increase in the similar option that we hedge in the ETO exchange traded option or the OTC market, over the counter market. So I'm just showing you what contributes to the changes of the price of a warrant, right? So this is when IV increase. So what happens to your warrant if there's a decrease of implied volatility, right? So decrease is also when there is a similar outcome lah, when the market confidence is decreasing. So it needs a lower forecast level of volatility in the market, and then the decrease in the implied volatility of a similar option and market. So basically, if you look at the warrant price Y, on the day one, right? Warrant Y on day one, Warrant Y is moving down one tick for every 100 points. So 21825, 21725, 21625. It is moving down by one tick, 100 points of the underlying. This moving according to the chart. So the chart is going down, warrant is going down accordingly. So normal, right? So what happens the day after, the next morning? The next morning, there's an adjustment of the IV from 50% down to 49%, 1% adjustment. So as highlighted in the red, right, Warren Y moved one tick from 428 on day one, the day before, despite underlying is increasing. So the decrease in price is attributed to the decrease in IV from 50% to 49%, right? So basically, implied volatility can be adjusted downwards, can be adjusted upwards according to the market movement. But we do not, as Macquarie, as a market maker, we do not adjust implied volatility during market hour. So we'll try our best to do that before the start of the market or after market, right? So this is something for investors to take note lah. Right. So just now, YC also explained on the number of stocks, the case studies that he went through. So in Malaysian stocks, we have multiple warrants over call warrants, mainly just call warrants lah, Macquarie. We only issue call warrants over Malaysian stocks, like NextG, EcoShop, Gamuda. Those are readily available in Bursa Market already. But why choose Macquarie itself is because we have more coverage in the foreign market, right? You can actually trade warrants in the Hong Kong stock market without actually leaving Bursa Malaysia. So sharing with you, this is the list, the updated list of Hong Kong stocks covered by Macquarie Warrants Malaysia. So look, we have coverage under the e-commerce or tech in the Hong Kong stocks such as Alibaba, Meituan, Tencent, and Xiaomi. In the EV or renewable energy, we have BYD, NEO, and CATL. So CATL is a new name that we've listed last week. So CATL is lithium-ion battery provider. So basically, this is a new stock, just recently IPO'd. You can actually check on the chart, the movement. Other than that, we also have F&B like Mishware. If you've been buying Mishware a lot, right, you can also trade warrants over Mishware. And PopMart. So PopMart is one of the popular names so far this year, right? So both PopMart and Cattle is the first structured warrants over the underlying listed on Bursa Malaysia. So for PopMart, we have both call and put warrant. If you think the price of PopMart is too high right now, right, you can actually leverage over the put warrant as well. Okay, so other than that, we also list index or ETF in Bursa Malaysia. So we have warrants of the Hang Seng Index, Hang Seng Tech, S&P 500, Nasdaq, Nikkei, and on the ETF side is the gold ETF and the E50 China. So why should you trade warrants over index instead of stocks? Well, one of it is the broader market exposure. So whatever the movement of the market, you could expose to it via the warrants over the index itself, and you can diversify, right, using both call and put warrants, and there's no single stock risk, right? If uh covering like a PN 17, or the company, sorry, the company is facing a PN 17 or facing any kind of financial issues, right? Any issues, of course you have the risk of the risk of a single stock, right? So if you trade warrants over index, no such risk, right? And then you're able to trade uptrend or downtrend of the market, right? So moving on to the trading strategy. So I think this is what I want to share with you the most lah. So just now YC showed to you um on how you can use technical analysis on stocks, right? So now if you look in warrants also, if you trade warrants, you look at the underlying, right? You look at the chart of the stocks or the index, not the warrants, right? So the correct way is to look at the chart of the underlying the mother share, right? So before I go to the strategies, right? Just to share with you the concept of moneyness come. So same as options, right? Your option can be in the money, out of the money, or at the money. So for structured warrants, in the money for call warrant is when the underlying price or the mother share is above the exercise price of the warrant. So for example, I showed you the CWGS that is 28,000. So for that CWGS to be in the money, right? Hang Seng needs to be above 28,000 for your call warrant of CWGS to be in the money. Whereas if Hang Seng is below 28,000, which means your warrant is out of the money. CWGS is out of the money. So if it's a put warrant, inverse relationship, right? Everything is different already, mirrored already. Okay. So basically, in the money means when your underlying price for call warrant, underlying price is above exercise price. For put warrant is underlying price is below exercise price, right? So why it's important? Because choosing in the money or off the money warrant contributes to what kind of trading strategies you will use with structured warrants. So for example, I move on to a first strategy, which is a bullish pullback trade, right? So for example, if you expect that the S&P 500 to rebound after 5 days of sell-off, but you have insufficient capital to gain substantial exposure to this one. All right. So you want to gain more leverage, but you don't have enough capital to buy futures contract over S&P 500. So what you do is you consider to take position is an S&P 500 call warrant, which is already listed in Bursa Malaysia and listed in Malaysian ringgit denominated, right? You take position in S&P 500 call warrants to gain leverage exposure to the movement of the US market. So this way, it provides you lower initial capital, and then there is no call, right? As opposed of you buying futures contract or the options market, right? So how you can do this, how you can trade S&P 500 call warrant is when the technical indicator that I suggest would be 8 days moving average and it is moving average lah. So this is what normally a warrant traders are using lah. So when the 8 days and 50 days moving average are well separated between each other, right? So it's wide between each other. So you enter when it is wide. So you consider to choose a more responsive warrant, a higher sensitive warrant. So a higher sensitive warrant usually is the in the money warrants. It tends to be in the money warrants, right? Sometimes out of the money warrant is safe, but then it also depends on you how sensitive you want your warrant to be, right? So what you can do is when the 8 days moving average and 50 days moving average is wide between each other, and you see a breakout, that is when you enter the S&P 500 call warrants, right? So you can also place a stop loss order for your own risk management, right? So example of a case study, translate into a case study is the S&P 500 C52, right? So when the S&P 500 index June features went up, the call warrant also goes up, right? So if you follow the same strategy lah, when there's a breakout and the 8 days and 50 days is well separated, because we want to look at short to medium term trading, right? So that's why we look at 8 days and 50 days. When it's well separated, you you are also looking at the S&P index string features lah, and then the S&P 500 C52 call warrant. So what happened is that during that period, when the index features is up by close to 1.9%, close to 2%, your call warrant will be up by 18.3%. So why it's more than why the call warrant is earning more than the profit is more than the index features is because of the effective gearing. So this call warrant S&P 500 C52 has a effective gearing of 9.6 times, which means 1% move of the futures would equals to 9.6% move of the warrant, right? So close to 2%, 18% move of the call warrants. So basically that's how it works lah, right? So this is a bullish trade, right? A normal bullish trade. So if you have any questions on this and how you can use this strategy, just let me know. Also, I think YC can also explain on this strategy as well. So basically what I use is just 8 days moving average and 50 days moving average, and enter when there is a breakout, right? So the next one is protective put trade, portfolio hedging. So basically, when the market is against you or the market is bearish, so you can actually enter using put warrants. So I give you an example of a scenario. Before a volatile or high risk event, like the day of economic data, or there's an earning release, or when Trump is about to announce another set of tariff that you think would be causing the market to be bearish, right? So at the same time, you are holding a specific number of shares, US shares in your portfolio, and you are unwilling to sell any of those shares because uh, um, because you just don't want to sell your portfolio right now. You just want to hold, right? But you want to reduce the short-term downside risk, right? Any downside movement, you want to make back based on that risk. So what you can do is consider to take position in the Hong Kong index put warrants, or even US index put warrants lah. For example, this is just, I'm giving you example of the Hong Kong market. If the Hong Kong market goes down, consider to take position in the Hong Kong index put warrant to protect your Hong Kong stock portfolio, right? So for example, put warrants over Hang Seng or Hang Seng Tech. So this way, you use small amount of capital, right? Because warrants are priced below 1 ringgit, you use small amount of capital to protect the capital that you have in the Hong Kong market against any downside move if it's about to be affected. So the technical indicator still is the same. Price stays below the 8 days and 50 days moving average, and you enter when the price breakout is below the previous low, right? Breakout is below the previous low. So you can consider for put warrant that has longer expiry date, longer expiry put warrant, and you can hold the put warrant as a hedge until the event is over, right? So this is how you leverage put warrant when there is a bearish market, all right? For example, for Hang Seng, right? So if a Hang Seng, there's a downward movement of Hang Seng, right? And then you want to leverage on that down movement. So what you do is you trade in the put warrant, because put warrant move the opposite direction. So if you did that, if you follow that strategy, right? What you get is when the July features, the HSI July features was down by 0.9%, the call warrant, the put warrant over that features, it went up by 4.9%, right? So this is just an example lah. But it's a real case study. This is what actually really happened in the market right now. This is as of 8 to 9 July, so just a 1 day period lah. If you were to hold a 1 day period, so you would have made a 5% profit on the downward movement. Okay, so moving on to the next is the pre-earnings trade. So you can also actually trade warrants when there is earning coming up. So for example, Alibaba, a tech company, is about to report earnings in the volatile market. So, and according to your analysis, your charting, right, you expect the stock to swing by 5% up or 5% down post earnings. So what you can do is consider to buy a call warrant and also put warrant over that stock. So this way you can capture both the upside and the downside price the downside price movement. So how you can do this is you enter at least 3 days before the earnings announcement date. use back basically you don't have to use the protective put hedge or the bullish trade because you are call warrant and put warrant. So what you can do is to just add the money or slightly out of the money for a lower capital outlay, meaning a lower bid and offer price, or you can choose higher sensitive warrants for faster break even. So higher, if you choose high sensitive warrant, which means you only need the stock price to move smaller, right? You can also set a stop loss order for both call and warrants. Okay. All right. So this is just example of the strategies that we can use to trade warrants in the in Bursa market. So how you trade warrants, basically you need tools. You need the tools. So Macquarie provide these tools for free on our website. So there will be a QR where you can just scan. It will direct you to our website. But for you to find our website, it's just Malaysia Warrants. Just Google Malaysia Warrants. Macquarie will be the first one lah. Okay. So the first one is that the tools that we provide is the Live Matrix Plus. So Live Matrix promotes price transparency by showing real-time warrant buy and sell prices, and also facilitate effective warrant trading plan and identify whether the warrant is tight or widespread. So basically, this is how a Live Matrix looks like. What it tells you is that at what point will you be buying this warrant? For example, CWGS. Normally you buy warrants is in you buy on the bid price, right? So warrant offer right now, for example, if it's at 9.5 cent, right? Because the futures is between 23,900 to 23,800, right? It's at 9.5 cent for CWGS. And then if you want to make one tick profit 10 cent, you would have to sell it back at between 24,100 and 24,000 here, right? The boxes that I showed to you. So that's how you make a one tick, and that's how you facilitate effective warrant trading plan. You can make more than one tick also. Depends on how confident you are with your analysis on the underlying. So the Hang Seng is you look at the futures market. You look at the futures chart, Hang Seng futures, right? So more on the bid and ask spread. When you choose warrant, right? You need to understand the size of the tick is if the warrant is priced below 1 ringgit, like 14 cent, 15 cent, right? Below 1 ringgit, the tick size is 0.005. If it's priced more than 1 ringgit, the size is 10. So this is the rule lah. Okay. So if you look here, the bid and ask spread, basically, right? So warrant with a wide bid and ask spread will incur high trading costs. Why? Because I explained to you, right? Look at CWGS. If you want to break even, right? You bought at 13 cent and you want to break even back at 13 cent. You only need the features to go up from 25290 to 25 to one level, right? But this is if you buy a tight spread between 0.125 and 0.130. So the difference is half a cent, 0.05. The difference is one tick. So if you buy a warrant if you trade a warrant that is widespread, the tick is more than 0.005, like CWGU. So this is the example, right? If you have been buying this warrant, trading this warrant at 0.540, and if you want to break even back at 0.50, you have to sell it back at a higher price, right? So which means you incur higher trading costs, right? Longer time for you to sell back, break even. So that's why when you trade into warrants, look at the price between warrant bid and warrant offer. The difference has to be 0.005. If it's more than that, there's a risk. There's a risk of you incurring higher trading costs. Okay. I hope you guys are clear on that. The QR, you can just scan and it will bring you to Live Matrix. Okay, so what we did new to the Live Matrix is we include all the terms boxes like exercise price, expiry date, effective gearing, and sensitivity. So these are all comments from investors because they want it to be easier for them to refer to. And then the Live Matrix shows the range of bid price even down to 0 ringgit, even down to 0, less than 0.005. And if it's less than 0.005, the matrix will still be shown there because if you want to sell back your position at half a cent, the minimum bid price, then you can still see lah at what point will the minimum bid price back. Okay, so that's on the live matrix. I just want to introduce you because I want to show you the steps to choose warrants. Right, the first step is you take a view of the underlying markets or the stock itself. If you are bullish or bearish on the underlying, you decide to go long or short. Okay, so if when you decided ready, you set the trading time frame. So are you a day trader or are you someone? Are you a swing trader? So or are you holding it for a longer period of time? So your trading time frame depends on the trading profile that you are, right? So effective gearing, and then after that you choose warrants with the right balance of risk and return. So what kind of effective gearing are you looking at? Do you want a higher effective gearing, or are you risk averse, right? You want something that is just lower effective gearing. You just want to make fewer increase, right? Or you are not keen to be affected by the higher volatile movement of the market. So choose the effective gearing depending on your profile, your risk profile. And then afterwards, you look at liquidity of the warrant. Basically, liquidity is provided by the market maker. All right. So more on liquidity will be explained later. All right, so this is how a warrant search looks like. Warrant search is different than the live matrix, but basically these tools are very important and for you to facilitate effective trading plan. I believe you need to use both of these tools, right? So why? Because like I said just now, the four steps here, right, can be translated into this tool. First, you determine you want to trade in Hang Seng warrant, so you determine that you are bullish on Hang Seng movement, and then you want 1 to 3 months. So you are a day trader or someone who just trade for a short term. So you want 1 to 3 months, right? And then you want something that can provide you higher profitability, right? So you choose 10 to 15 times gearing. And then when it comes to the liquidity, right? Liquidity is actually provided by the market maker. Compared to what was told by YC earlier, stock market, if you go into stock, right, you look at the volume, the higher the volume, which translates to the better the stock is, lah, right? Basically, but for warrants, the volume does not translate to how the warrant is doing, right? Even though the traded volume is high, the liquidity might be low, right? So what liquidity am I talking about? Is basically the bid volume and the ask volume. If it is high on both sides, which means it is a high liquid warrant, and um traders would usually go into high liquid warrant because they want to buy and sell easily, right? I'll explain to you more on that. But this step 1 to 4, if you have been doing this step, right, following this step, and assuming that you want to trade Hong Kong stocks and you choose POPMAT C1, you follow the step that I showed you earlier, right? You want to trade POPMAT C1. So then where we move from the warrant search to the live matrix, right? So first, when you want to trade POMAT C1, you determine the entry and exit level of the underlying share. So by this time, you already have a chart on you have already studied POMAT chart, and you want to enter at 263 and exit at 274. So what is the price to enter and entry for POMAT C1? Basically, right, at 263, you would have bought at 0.275, the warrant offer. And for you to sell at 274, right, you would sell at 30 cents there. So basically, when you sell at 30 cent, but the potential gain that you get is 9.1%, while the underlying gain 4.1%. So basically, this is how you use live matrix. It's quite straightforward. Uh, it just show you at what point the price is at and at what point the price is supposed to be. Right. So Macquarie, we will try to be true to the matrix, right? If there is something that is wrong with your matrix, or you can always just call us on our hotline. So I'll share with you our hotline later, right? So for similar as stocks, right? For warrants, you can also put a stop loss. I explained to you the trading strategies. So if you buy POMAT C1 at 290 and want to set a stop loss at 270, the last defense, right, you buy at 290 and you set a stop loss at 270. So the last defense is basically the underlying bid, the blue box, the 262.6, right? So basically, this is your stop loss, right? So in your chart, you already bought 290 and you set a stop loss at 260.6, 262.60. So basically, your stop loss is 270, right? That's the stop loss that you need to put in your trading platform, right? So question that I recently get is that if you hold warrant until expiry, what will happen to your warrants, right? So just now I talked about time decay, but I haven't had time to explain. So time decay is basically the time value portion of a slope of a warrant's price, which will slowly be reduced throughout the life of the warrant, right? So the time decay of warrant is not constant and will speed up as the warrant approaches its expiry. Okay, so for example, general rule of thumb is that a warrant near its expiring date will lose two-thirds of its life, showing that the rate of decay is much faster. So basically, if you have bought a warrant at listing date here, the one-third of its lifetime is slow. The time decay is slow. It won't be affected by time decay. So if you have bought warrants that is newly listed or at one-third of its lifetime, probably the first 2 3 months where it has been listed, you won't get any much time decay. But if it's closer to the expiry date, right, the time decay will be faster to hold it, right? Time decay is only affected for those who hold warrants more than overnight. If you are an intraday trader, you are not. If you buy and sell on the same day, you're not affected by time decay, lah, basically. Right. So for those investors or traders who hold warrant until expiry, what happens to your warrant? So if your warrant is expired in the money, you will get cash settlement. So how you calculate cash settlement is basically, this is a template calculation lah. So we will be posting or announcing this template calculation alongside the real calculation in Bursa Malaysia as at 5 p.m. on after 5 p.m. on every expiry day. Okay, so basically for call warrant, it's just direct lah. Number of call warrant that you hold times settlement level minus excess level times the exercise ratio and also the settlement exchange rate. So if this is a stock, Malaysia stock, right? There's no exchange rate lah. So you don't times the exchange rate basically, and the settlement level change the price, exercise level also change the price. So this is how you calculate if your warrant expires in the money. In the money, like I explained earlier, for call warrant, is the underlying price is above the exercise price. So if your warrant is expired in the money, so we'll have cash settlement, and this is how you calculate your cash, right? So if your warrant is a put warrant, it goes the other way lah, basically, exercise level minus settlement level. So for put warrant, the exercise price needs to be above underlying price for it to be in the money, right? So what happens if your warrant is out of the money, expired out of the money, and then you cannot sell back a position because it's already worthless below 0.005? Basically, you would be losing the capital that you invested in, right? You will not get any cash settlement. You will lose all your position, right? So that's why in all my webinar, I need to press it to you that do not hold warrants too long, because it's not for a long-term investment. It's for short to medium term, and usually people hold and not hold until expiry lah. So that's the rule of thumb lah. It's a short-term investment, like short-term trading. Okay, so, hopefully it's clear so far. The risk and consideration. So risk when it comes to trade warrant is you'll be exposed to market risk if you trade the foreign underlyings, and also the exchange rate risk. But exchange rate risk is nowadays for warrants we are fixed on the exchange rate lah. So even though there's a fluctuation in currencies, your warrants are still are not affected because the FX is fixed. Okay, so market risk is more of how's the movement of the market. If you are exposed to the risk of the share price, index futures, or market as a whole, which move against you, and then the price will also move the same way. So example, like the COVID-19 pandemic, there's a US sanction or there's tariff announcement. So all of this will affect your warrants if you will trade warrants of the foreign underlyings. Okay. So limited life is just basically talking about expiry. Do not hold warrants until expiry. So do not trade warrants and look it as a long-term expiry. And for gearing, right, is yes, gearing, the higher the gearing, the more the profit potential, but also the more the potential for you to lose also, right? So it's double-edged sword. Just remember lah. Right. So just some FAQs on warrants. So just now I talked about liquidity. If you look at stocks, right, the high daily volume indicate large numbers of buyers and sellers. Okay, so that's a good stock really lah. So stock A traded volume, stock A traded volume is 7.2 mil, but stock B is 16.1 mil. Of course, if this is just a normal stock trading, we'll go for stock B, right? Right. So but for warrants, it's the other way around, right? So for warrants, even though the traded volume is increasing, high, but then the warrants of the bid and ask volume that is provided by market maker is low. So it's something that you need to consider. Okay, so market maker provides liquidity in warrants by providing continuous buy and sell quotes. So that's the role of Macquarie here. So Macquarie provide you the liquidity, so you don't have to depend on the traded volume of the market, even though the traded volume is high, like 200 million, but the bid and ask volume is only 200,000, which means, right, if you enter call warrant Y, right, and you have 2 million units of call warrant Y, and if you want to sell back your position at the bid volume, it's very slow for you to be filled. 150,000 is very slow because you have 2 million units already you're holding and you want to sell now, right? It's very slow already. So if you have 2 million units of call warrant X, all right, and the bid volume is 2 million, it's just one time fill, right? So that's what it means by liquidity. It's the ease of you buying and selling your position in that warrant itself. So the bid volume and ask volume is where you should be looking at, not the traded volume. Even though the Hang Seng trade volume is very high, 300 million, 400 million, but if the bid volume and ask volume is low, you will get you will get stuck in the warrant, you know. Okay, so just keep in mind, because market maker provides liquidity, right? If you trade in stocks, there's no market maker. In warrant, there is a market maker. We provide liquidity. We provide the ease of you to enter and exit the market easily. Right, so that's our role as a market maker. Okay, so just remember, when you trade warrants, don't just look at the trader volume. Also look at the bid volume and ask volume. Okay, so call warrant X is the best in this case. All right. So all our index underlying actually trades the futures. We have the live futures index for Hang Seng, Hang Seng Tech, Nikkei, and KLCI. But if you want a live chart, I think I would suggest you to go to Trading View lah. Basically, so far they have the better option. They are the better option. Okay. Otherwise, index futures rollover also it changes every month for Hang Seng Tech, and KLCI. For S&P 500 and NDX and Nikkei, the contract is rollover every quarter. Right, so this is just a FYI for you guys if you want to trade warrants over the index. And then this is the market making hour of each underlying. So every underlying has a different market making hour. Sometimes they are similar in morning session, but afternoon session sometimes like Hong Kong index, they close 428. Hong Kong shares, they close 358. So that's a difference lah, right? So this is following the Hong Kong market and the US market or the Nikkei market, right? So this is the trading hours that we follow. Okay, so yep, I'll end my session here and open for Q&A. So this is just showing you my hotline here. Also, there's an email, and also you can join our Telegram channel, Facebook, and our newsletter.
All right. Thanks, Afiq, for sharing with us how do we use structured warrants to complement momentum trades. So if you have any questions to ask our speaker, you may write them at the Q&A box. So the first question from Lester is that do we need to open a Macquarie account to trade structured warrants, or we can use with our existing broker account?
Okay, so I think this question also was raised by Muhammad Imran. No, you don't, because Macquarie is not retail broker, so we don't do any account opening. We're just an issuer of structured warrants. So basically, you can start to trade warrants using any of your own account, all right? That as long as it's licensed by the SC, you can trade using any accounts in Malaysia. Okay.
All right. Thanks, Afiq. Um, do you have any suggested screener for newbie to detect potential good warrant based on your sharing?
Screeners detect potential good structure warrant. Okay, so basically, I would say structure warrant is quite okay. Can you see my screen, Ashin?
Yes, we are looking at thank you page.
Okay, wait. I will show you another page. So basically, there is a screener that we provide in our website also. Show you another page. Right. So this is just a Google lah. Show you example how you can Malaysia warrants, or you can Google our website. So when you type Malaysia warrants, you will just go here. So website is all for educational purposes and information sharing only. So it's free for everyone to use. So the screener that I'm talking, that I'll be sharing with you is called the warrant heat map. So basically warrant heat map is where you can get idea of what is going on, the weekly momentum, or there's a monthly trend of bullish or bearish in any underlying in the market lah. For example, if you are trying to trade pop mark warrant, right? Pop mark, you would look at the chart here, right? So this is a chart lah, indicating that the where the format is going right now. And then you see this pentagon, right? This is called green and red pentagon. Green pentagon means there's an up signal. Red pentagon means there's a down signal. So basically, this is where you can enter your position of warrants lah. We don't really have a screener where it will prompt to show you which warrant to buy at right now, or I mean like what is, I mean there's no notification, but what we do is providing you this heat map, and from the monthly trend and the weekly momentum, you can actually make your own trading suggestion lah. So basically, and then you click here, pop mic here, you will show you the call or put warrants over this underlying. So basically, this is the screener that we have lah, provided by Macquarie. So these are all for free. If you want for, what I say, YTL power lah, okay. So this is the technical analysis chart of YTL power. So green signal, there's no pentagon signal so far, right? For warrants, you can choose lah which warrants is you can actually compare the warrants here, right? So comparing, depending on you, effective gearing. You want something that is very high effective gearing or low effective gearing. You want something that is the bid and ask price is higher or lower, depending on the capital that you are prepared to invest in. So you want something that is longer expiry term or shorter expiry term, depending on your profile. So basically, there's a lot of ways where you can use the heat map, but basically just provide you information. Okay, so EcoShop, uh, this is the warrants of the EcoShop that we have, right? So you can see lah, 9 cent, right? Price at 9 cent, price at 2 cent, price at 4 cent, comparing of you just buying the underlying itself. If you look at Tenaga, right? So Tenaga share price is quite high lah, right? Around 14 cent, right? But if you buy the warrants as an alternative, you just invest 11 cent or 1.5 cent, right? And you have the chart whether the Tenaga right now is red pentagon, so there's a down signal. But for Malaysian stock, just remember we don't have any put warrants of Malaysian stocks, right? So hopefully I answer your question on the screener.
Thanks, Afiq. Chan would like you to, maybe next time explain more about rollover in your Telegram channel.
Okay. Explain
Yeah,
more about
Chan.
rollover in Telegram channel. Okay, we
For the
can do a write-up.
Hang Seng Index structural warrants.
Yes, we can do a write-up on that as well. Next week probably. So I'll take that as a suggestion. Next week we do a write-up about rollover. Okay.
Okay. So just now I mentioned that there are no market makers in the option market, and Shun Ken just want to double confirm that.
Okay. All right. So because it's listed by the options itself, so the option itself is the market maker lah probably. But when it comes to warrants market, right, you have multiple issuer. So this issuer, they market make their own warrants. All right. So if Macquarie provide liquidity for Hang Seng is up to 12 million, other issuer they cannot provide up to 12 million. Maybe they provide up to 4 million, 3 million, 2 million, depending on how they market make. So what I'm trying to say is that for structured warrants, there are multiple market maker and they only market make over their own structured warrants only. So that's what I'm trying to share with you lah.
All right. So the next question here is just like I mentioned about IV, you give some example about IV. So in what circumstances will you amend the implied volatility? Will it just like I think you mentioned about that you will do it um when there's non-market hours, right? So
Yep.
do you also do it during the lunch break?
Okay, so for lunch break, it depends on how the features performing, but that is not common lah. So commonly, IV adjusted is before market open. So if you are avid Hang Seng trader, Hang Seng warrants trader, suggest for you to look at 915 chart, right? 915 live matrix, 915 live matrix, and if you want the cash, you want to follow the cash market, also suggest for you to look at when the at 9:30, right, when the cash market is open also. So we will try our best not to do it around lunch break. So it's not common. It will happen if there is a spike in volatility in the futures or the hedging that we did in the market.
All right. So Eng Kyong have a follow-up question. So by what
Mm.
time the live matrix is finalized for the day in terms of the prices? It is very difficult to trade when the metric is continuously changing. So his comment is that some market makers finalize the metric even before the market opens. So what's your view?
Okay, so Eng Kyong answers the same. I have the same answer lah. With how PK Lim question. So basically, right, the life matrix follows IV also. It is affected by the IV because IV affect the price of the warrants, right? So if there is a spike IV before overnight lah, for example, for Hang Seng, right? We will make the changes in the warrants like volatility. So um okay, so the live matrix is finalized by 9:15 lah. If you look at Hang Seng, right, usually it's finalized by 9:15. Before market opens, we have already um the live matrix tend to not change during market hour because we don't do any adjustment during market hour. So that's how it is lah, commonly. So you can look, if you look at Hang Seng Index by 9:15, or if you look at any other underlyings by the time it opens, it is already a fixed matrix already, right? So if you look at earlier, maybe we haven't put in any adjustment, or maybe there's no adjustment lah. So if you want to look at the exact moment, is the exact moment where it's open, the live matrix, when the market is open.
All right. Thanks, Afiq, for the clarification. So let's do one last question because it's 12 o'clock now. So
Okay.
Lee asked, can we still trade the warrant if the warrant shows zero volume?
All right. The warrant shows zero volume. Okay. Yes, you can. Okay. When you talk about volume, right? Traded volume, you can still see my screen, right?
Yes.
Okay. Yes, you can. You can still trade warrants over zero volume, pertaining that the bid volume and ask volume is still there, right? So let me show you example like EcoShop CM. So even though no one is trading this warrant yesterday, right? But Macquarie is providing bid volume of 4.8 and ask volume of 1 million. You still can buy this warrant. You still can buy this warrant, and then you still can sell this warrant also. So it's easy for you to do that. You do not need to see the traded volume of the warrants. What you can do is you see the traded volume of the stock itself. So common misconception is when you trade warrant, you look at the warrants. So actually, you just look at what is going on with the underlying, not the warrant, right? So for warrants, market maker, we provide bid volume and ask volume for you to trade warrants. So even though it's still zero, you can still buy and sell perfectly, meaning you buy and sell with us, the market maker.
All right. So that's all the time we have for Q&A with our speakers today. So I would like to thank both our speakers, YC, for sharing with us the technical trends in the Asian market. And then we also want to thank Afiq for sharing with us how do we use structured warrants effectively to trade the Asian market.